and you've had a really, really good year, you may want to look at whether or not to buy that SUV this year or not. I've talked about that SUV in prior years. I'm going to hit it again today. But the deduction for the SUV or the pickup truck is just really, really a good deduction, and is a good way to get a deduction at higher marginal rates this year as opposed to lower marginal rates next year. So in a nutshell, if you can decelerate income and put some income into next year, get the deductions into this year, that's not a bad thing at all to do. Now, I don't know whether we're having technical difficulties or not. Okay, the last message I got was we're all fixed. So I'm going to keep on going. The other thing that I have read about, and I also agree with this, is sales of some properties, sales of stocks and things like this, and some real estate properties might be subject to something called the net investment income tax. This is a 3.8% add-on tax that we've had since 1913 because of the Affordable Care Act. Well, one thing I have read is that Donald Trump wants to do away with that net investment income tax. So if you're contemplating a large sale or a profitable sale of stocks, mutual funds, real estate, things like that, this year, you might want to consider putting that off till next year, again, possibly because of lower rates, but secondly, because of the elimination potentially of that 3.8 net investment income tax. So let me summarize. Decelerate income, push it off till next year, accelerate deductions, get some of those deductions into this year, and third, and finally, consider if you're going to sell an asset that's going to result in some capital gains and subject to the net investment income tax, that it might be wise to think about putting it off till next year. However, as I say this, envision yourself in Las Vegas for just a minute, holding the dice and basically playing the game of craps. Is it going to really happen next year? Will it happen? Will it not happen? Who really knows? It's just a betting person's game here as to how fast some of these tax laws might change. Now, let me get into some other issues that we're going to talk about today. I want to talk to you about a record-keeping app that I have found in the last 6 months. And it's been around for a couple of years, but I just really caught on to this in 2016. And the app is Mile IQ, M-I-L-E, capital I, capital Q. And this app is probably the most significant device or method I have ever witnessed to keep track of the mileage on your vehicles for business purposes. And let me give you an example. So I left my house today to drive to the facility where I'm doing this webinar from. And basically, I've got my phone on, and the Mile IQ app is on my phone. So when I get here, I look at my phone, and it registers the mileage I've driven, which in this case was about 8 miles. And then if I swipe right, it logs it as a business trip. And if I swipe left on my iPhone or Android, then it basically codes it as personal mileage. And at the end of the month, it will send to my email a monthly report of my total mileage, business, personal, as well as the percentage. And it also even codes the addresses of where I came from and where I've gone. So, most of you know that I was an IRS agent for 16 and a half years. Had this app been around during my IRS career, I would have been a lot tougher on people as to whether they had good records for the use of their vehicles. So what I want you to do is this. Try this app for 30 days. Just try it. I have no financial interest in telling you this, so I'm not trying to make a dollar off of you, and I don't want you to use my name when you basically go for this app. Now, what you'll do is the app is only good free for 40 trips a month. And in my case, I have a lot more than 40 trips a month, and you realtors will too. But try it for a couple of weeks free. And then if you like it and you know you're going to use it, then pay the $59.99, which is an annual fee. to basically have unlimited trips per month and per year. And I think you'll like it. One last thing, I do about 150 tax returns a year, and basically for all my self-employed clients, I really, really push them to use this Mile IQ app. Okay, let's talk about tax strategies now. Besides the deferring income, accelerating deductions, I have to talk about the S corporation, the subchapter S corporation. Excuse me, I am an S corporation. Most of my clients are S corporations, and I've been asked if I could repeat the name of the app one more time, and I will. It is Mile IQ, spelled M-I-L-E, the letter I and the letter Q, I believe all in caps, but it doesn't really matter. You'll find the app anyway. Okay, let me talk about the S corporation. The subchapter S corporation is something that's been around for many, many years. As an IRS agent, I was auditing these type of returns literally 20, 25 years ago. So this is an opportunity that if you take your sole proprietorship or your limited liability company business into the status of an S corporation, you have the opportunity of potentially eliminating anywhere from $4,000 to $6,000 a year of Social Security taxes. Let me say that one more time. If you incorporate as an S corporation, instead of staying a sole proprietorship or an LLC, you have the opportunity to save annually anywhere between $4,000 to $6,000 in Social Security taxes. And the way this is done is basically it's a salary issue as to how much salary you take out of your S corporation each year. And you're going to have a thorough talk with your accountant because nobody really knows what is the right amount of salary, although the IRS regulations tell you that the salary must be a reasonable salary. So you can't do your own returns. You can't use TurboTax for this. You've got to go to a good tax professional and talk to them about the benefits, pros and cons of being an S corporation. Now let me tell you this. I do what I say. I believe in what I say. Your instructor has been an S corporation since 1991. Most of my successful clients, whether they be real estate clients or whether they be non-real estate, but self-employed, of course, I try to move them into the S corporation. Now, one thing, today is December the 19th of 2016. If you are thinking about this anyway, or as a result of this webinar, then the thing you need to think about is possibly forgetting it this year and thinking about it starting January 1st of 2017. In fact, if a new client came to me today and they were self-employed, I would recommend that we just worry about this next year and let basically bygones be bygones for 2016. However, if we were doing this earlier in the year, for example, in July or August of 2016, I would have definitely made you an S corporation this year, possibly August 1st or September the 1st of 2016. Now, as always, there's just no one tax strategy that is best for all. For example, I'm going to talk a little bit later about the 105 medical reimbursement plan. And there are pros and cons to that as well. But I will tell you that one of the costs of becoming an S corporation is that you cannot take advantage of the 105 medical reimbursement plan that I'm going to discuss later. Likewise, some of the disadvantages of the S corporation are that you have to file quarterly payroll tax returns, Form 941. Your accountant's going to charge you to do that. You're going to have to do an annual S corporation return, Form 1120S. Your accountant's going to charge you for that. So this is not all just a cakewalk. It's something that you seriously need to consider. But if you are making typically anywhere from $70,000 to $80,000 or more in gross commission income a year, and you have not considered an S corporation, I think you might be missing something. So just want to give you a heads up on this. and really don't know how the S corporation is going to fare under potential tax reform next year. A lot of us don't know the answer to that, but they have done very well over the last 20 to 25 years. And one comment I would like to make is that President-elect Trump's tax ideas do include the distributions from pass-through entities like an S corporation to be only taxed at a maximum rate of 15% versus the current rate of which it could be as high as 39.6%. But that is something that I know nothing specific about. Congress has got to look at those proposals, and personally I think it's a long shot that we could think that S corporation distributions other than salary would be only limited to a 15% tax rate. But it's something for you to watch and think about, and I'll be talking about this next year as we see the tax laws evolve. Now, something else that's really come up that's really, really significant, and that is for those of you that own rental real estate, you want to make sure that you talk to your accountant about something called, and I'm going to say this slowly, is called the de minimis safe harbor deduction. Let me say it one more time. De minimis safe harbor deduction. And this is a deduction that came about a year ago. In fact, on November the 24th of 2015. This new safe harbor deduction is up to $2,500 per invoice, or even more important, per item on an invoice. And this serves as a deduction instead of you having to, what I call, capitalize something and then depreciate it slowly over 5 years or 7 years or even 27 and a half years. You are allowed to deduct it in the year you paid the money to purchase it. And let me give you an example. As we speak, my wife and I are building a 2-unit condominium complex. I'm going to call it a duplex for all practical purposes, although both sides have their separate PIN numbers. But we're going to have 2 washers, 2 dryers, 2 ranges, 2 disposals, 2 refrigerators, 2 microwaves. And what I'm going to do is I'm going to have the builder give me an invoice for those items. And I'll guarantee you this, as an owner of a lot of rental property, you don't pay more than $2,500 for any one of those items. And if I get this invoice from the builder detailing these items out per item on an invoice, this will give me the option of claiming the de minimis safe harbor deduction in 2017, the year we close on this piece of property. And if I don't get the invoice, I have no opportunity to claim the deduction. If I do get an invoice, I do have the opportunity to do it. Now, this may not be as good for everyone as it would first seem, for this reason. My wife and I are real estate professionals. That is, between the two of us, real estate is our life. In my case, my wife's. She spends more than 750 hours a year, and we manage our own properties. And those are the 3 prerequisites. You got to spend more than half your time in real estate. You got to spend more than 750 hours a year, and you basically have to manage your own properties. And if you do these 3 tests, then you are allowed to deduct all your rental expenses against your rental income and are not subject to the so-called passive loss rules of Internal Revenue Code Section 469. So if some of my listeners are not allowed to write off all their deductions because of what is called the passive loss rules, that is, they are not real estate professionals, then this is not near as important to you. The de minimis safe harbor deduction is not near as important to you as it is to somebody who can write off all of your deductions. Now, the de minimis safe harbor is not only limited to rentals, although that is where its prime importance and relevance is. Every one of my participants in this stream are probably self-employed, which means that you can take this deduction against your business income as well. However, you've always been able to claim Section 179 of the Internal Revenue Code, which basically gives you an expense of items that you buy, like equipment, like computers, up to $500,000 a year, which none of us would ever get close to anyway. So let me just summarize. The de minimis safe harbor is really, really a great deduction. It is especially good for owners of rental real estate. And on top of that is really good for people that can take all their deductions. But for people that would not otherwise qualify to take all their deductions on their rentals, it's probably just not that good of a deduction. Now, I'm always talking about automobiles, so I want to continue with the discussion on the write-offs for automobiles, pickup trucks, and SUVs. Just last week, first, the IRS released the standard mileage rate for 2017, and it's going to be down 1/2 cent from 54 cents in 16 per mile to 53.5 cents per mile in 2017. Now, personally, I use the standard mileage rate, and coupled with the Mile IQ app, it really, really is good. However, I drive between 28 to 33,000 business miles a year, plus I drive reasonably priced cars. The vehicle I'm driving right now is a Toyota RAV4 that I think I paid $28,000 for. Now, the standard mileage rate is really good if you drive a lot of miles and you drive reasonably priced cars, and that's me. However, I know a lot of you drive SUVs, and you've heard me talk about this before. If you drive a qualifying SUV, that is a SUV that has a gross vehicle weight rating greater than 6,000 pounds, and this has been the same thing I've been teaching since 1987. This vehicle qualifies for a deduction that will literally knock your socks off. I'll give you an example. If you spent $65,000, for example, on a brand new SUV and drove it 90% for business, I'm telling you the deduction for that vehicle in the first year would be in the mid-40,000 range. Whether you even have made a payment on it or yet, or whether you paid cash for it, this deduction is just phenomenal. Instead, if you drove this vehicle, if you bought this vehicle used, your deduction would be in the neighborhood of $32,000. So $65,000 new would be in the neighborhood of $40,000 to $45,000. You buy it used, it dips down to $32,000. But the best deduction is for people that drive a pickup truck with a bed length of at least 6 feet. And this deduction is the same whether it's a new or used pickup truck. And I'll give you an example. If you drop $50,000 into a new or used pickup truck, drove it 90% for business, the first year deduction would be $45,000, just simply 90% times the $50,000. So the deal is this. Let me kind of summarize. You're either going to use standard mileage rate or you're going to use actual expenses. I use the standard mileage rate because I drive a lot of miles and drive reasonably priced vehicles, and I don't like the heavy SUVs. I never have. All right. Now, you're either going to choose standard mileage rate or you're going to use actual expenses. So actual expenses means you're writing off gas, oil, tires, batteries, fuel, insurance, interest on the loan, etc. Right? And you've got to use actual expenses if you're going to claim the big vehicle deduction. So if you claim the vehicle deduction for the heavy SUV, a gross vehicle weight rating greater than 6,000 pounds, or you drive the pickup truck, right, you're going to be claiming gas, oil, tires, batteries, and all that stuff for the life of that vehicle, and you'll never be able to use the standard mileage rate. But, you know, it's for your choosing. And one more comment, too. I'm 5'5", all right? And it is a haul for me to get into one of these big SUVs. It's just not me. I rented one a couple of months ago in Virginia when I was doing a seminar, and I felt like I was driving a truck. But that's just me, not you, all right? So I'm very satisfied with the reasonably priced vehicles and the standard mileage rate. Now, I don't know whether you've talked to your accountant about this next item or not, but the home office deduction has been gaining a lot of steam in the past couple of years. And I know a lot of you are going to have negative attitudes about this deduction because your accountants have told you this is a red flag and is surely going to get you audited. Well, let me tell you this. I hate to burst their bubble, but the IRS is not doing many audits now because of low funding, lack of manpower, things like that. So they're not doing many audits, but I would never tell you to do something wrong just because they're not doing a lot of audits. But in 2013, the IRS revised its rules on the home office deduction so that basically they created a manner in which you can claim this deduction where it would be less of a red flag with the IRS. And they call this the Office in the Home Safe Harbor Deduction. And if you're getting a little collateral noise out of this, they're playing with some ladders outside the conference room that I'm talking in. So that's what that clanky noise is, and I can do absolutely nothing about it. Hopefully I'm the only one hearing that, nobody else is. But back to the home office deduction. First of all, the prerequisites to the deduction, and I take no prisoners here, is you have to use the space exclusively, notice my emphasis, for business and on a regular basis. So in my own case, I mean, I have a beautiful office in the home, in our home in the country, and it is a room adjacent to our master bedroom on that wing of the house. There is no other use of this office at all, and that is the headquarters and only office of Chris Bird Seminars Incorporated. So I use it exclusively, and then I'm allowed to claim the deductions under one of two methods. But before I go into those two methods, let me sell you on one other point. When you have a home office deduction, the office in the home, the real secret to this deduction is that your business mileage starts the minute you back out of your driveway to go anywhere, whether to go meet a client, whether to go to your regular office, whether to go to your broker's office, whether to meet a client for lunch, whether to go show properties. You're on the business clock the minute you back out of your driveway in terms of mileage, which means you have even a better deduction because of the home office deduction. And personally, I believe that is why the IRS never did like this deduction, is because it has a doubling effect on your tax return in terms of lowering your tax liability. Now, back to the two methods. The method that I have used for years, and it still works very, very well, is basically you calculate actual expenses. And in my case, my office in the home is about 8% of the total finished square footage of the house. Now, what I see on returns is anywhere from 5 to 15% based on how large the office is and how many square feet the home has of finished square feet. So I'm allowed to claim basically 8% of my mortgage interest, of my real estate taxes, of my insurance, of my utilities, of my repairs and maintenance, things like that. I'm also allowed to depreciate 8% of the cost of my house. Now, the other method, the second method, is rather new. It started in 2013, is called the Office and Home Safe Harbor method. And in this case, the IRS allows you to claim $5 a square foot as a standard amount for the office square footage. So if you're using 200 square feet, you would be able to claim $1,000. Now there's a limit of 300 square feet, at least in the regulations right now. So your maximum deduction is going to be only $1,500, 5 times 300. So if you're using 400 square feet, your deduction will be limited to 5 times 300 square feet. But if you're only using 200 square feet, your deduction would be limited to $1,000, 5 times the 200. But remember that you're going to be able to take your mileage from the minute you depart your residence if you're on business in your vehicle. Now, also, I'm going to basically end this call at about 1:45 to 1:50, and then I'm going to try and answer as many questions I can in the remaining time. And I know I've been getting some questions on my phone, and I will get back and to do my best to answer as many of those as I can. However, let me just suggest this too. While I cannot guarantee you that I can answer all emails I get, my email is chrisbirdseminar, CHRISBIRD, seminar, SEMINAR, and don't laugh at me, it's an old account of mine, at AOL.com. But if I don't get to your message or your question, and I'll do my best in the next couple of weeks to try and get to as many as I can that I don't get to today. Okay, so there's the 105, there's the home office deduction, which I really, really recommend you look at. And one more thing too. A lot of accountants are wrong, or their thinking is erroneous when they tell you that when you sell the house, if you've claimed the home office deduction, that you will pay a very, very significant price tag because of the depreciation that you've claimed. Well, I respectfully disagree with them, and this is my business, and I will simply tell you that if you claim the first method for claiming home office, like I do, and then basically you sell the house, you will owe a little bit of tax because of the depreciation. But it's never been a deal breaker. If you'd owe a couple of $1,000s in taxes because of claiming the home office deduction, considering the taxes you've saved by claiming the home office deduction, I would think it's a no-brainer that it's still the thing to do. And secondly, if you use the safe harbor method, the new method that started in 2013, there are no paybacks when you sell the house through depreciation. So that's totally a have your cake and eat it too. Now, I've got to talk to you about a tax saving strategy that is also a retirement saving strategy. And that is, what is your plan on accumulating sufficient assets so that sooner or later you don't have to sell real estate to basically pay your bills and have a comfortable retirement? So those of you that have been around with me for the last 20 some odd years, you've heard me talk about the benefits of the 401k for the self-employed, the SEP IRA for the self-employed. SEP stands for Simplified Employee Pension, and the Simple IRA for the self-employed. And SIMPLE stands for Savings Incentive Match Plan for employees. And I'm just telling you this. These three plans, all right, provide a technique, a system, where basically you can put money away, get a fairly significant tax write-off in the year you put the money aside, which obviously is a tax deduction. And the money goes into a retirement account that hopefully builds for you through wise investing and things like this. And granted, the money comes out tax deferred, and when you take this money out later in life, you're going to pay taxes on it. But typically, people are coming out in retirement at lower tax rates than they were when they earned the money that went into it. Now, the ultimate there is the Roth IRA, if you want to do something like that. But the problem with the Roth is that the money goes in on an after-tax basis, although it comes out basically on a tax-free basis later in your life. So the 401k, the SEP IRA, and the Simple IRA, you're putting basically pre-tax money in, and this coming out taxable later in your life. With a Roth IRA, you're putting in after tax, and it comes out tax-free later in your life. And I simply implore all of you to think about this. And I'm a certified financial planner. You've got to think about what your plan is to retire on. And, retirement can be at any age you want it to be, but you still got to have the assets to do it. Now, personally, I like the 401k. I like the 401k because I can put away more money into the 401k than either of the other two. The 401k allows me to put more money away than the SEP IRA does or the simple IRA. And there's some other features that I like. For example, the fact that I can add a Roth 401k to my regular 401k, but I cannot add a Roth 401k to a SEP IRA or a simple IRA. So here's my challenge to all of you. If you're going to go with a 401k or the simple IRA, and literally it's too late now to do the simple IRA for 2016 if you haven't done it already. But the 401k must be set up in writing by December 31st of the first year you're going to set it up. So what you want to do is have a meeting with your financial advisor like Edward Jones, Prudential, Beige, Ameriprise, whatever, prior to December 31st if you want to set up the 401k. If you're going to do the SEP IRA, there's no rush. You have until next April or next October to both set up the plan and put the money in. And the April is if you file by the normal due date, and the October date is if you file by extensions. But it is a seminar in itself to really take you through the pros and cons of the three plans. However, I really want you to talk to your financial advisor and determine which one best suits your needs. And again, your instructor uses the 401k as I have done since 2006. Now, let me talk about the 105 medical reimbursement plan for a few minutes. This is a plan that basically fits a very narrow group of people. In fact, of the 300 people I have basically watching this stream, I would tell you that maybe 5 to 10% of you may qualify for this. To have the 105 medical reimbursement plan, you must meet 3 requirements. First, you must be married. You must be married. All right? Secondly, you've got to be self-employed. And third, basically, you've got to be paying 100% of your health insurance, medical expenses, and basically your health insurance premiums. If you don't meet all 3 of those things, for example, you have a spouse that has a job and you have a health arrangement through the spouse's job. Well, you cannot use a 105 medical reimbursement plan. But if you do meet those 3 requirements, and some of you do, then the 105 medical reimbursement plan is the coolest way to save money. And that is because you have to hire your spouse as a part-time employee. You offer them the health insurance and medical reimbursement plan for you, the spouse, and the children, if there are children or dependents. And it puts all of your deductions, for medical expenses and health insurance on your business schedule as a business expense. So if you're a sole proprietor or an LLC, this will save you federal income tax, potentially state income tax, and also Social Security tax. But remember, I also said earlier when I was talking about the S corporation that I am so high on, that you cannot basically use the 105 medical reimbursement plan in conjunction with an S corporation. It just doesn't work. Now, the next thing I'd like to talk to you about is the 1099 requirements. And let me save you some money here. The IRS is really getting down on the underground economy. The latest statistics I've read, they estimate there's over 360 billion, that's with a B, of underpaid taxes almost every year because of the so-called underground economy. So, I'm no Boy Scout here, but I would tell all of you, you don't pay cash, you don't accept cash, and you don't get paid cash in the business of real estate anyway. But I would never pay somebody in cash, and you've got to issue 1099s if you are paying somebody to work for you in your business who is not an employee of yours if you pay them $600 or more in a calendar year. Now, here's the key. If any of you use basically photographers, if you use sign people to basically put signs in yards, things like this, and this is just two that I can think of off the top of my head. But if these people are not a corporation, if they're not incorporated, you need to give them a 1099 if you pay them $600 or more in a calendar year. And here's the procedure. What you need to do is have each one of them fill out a Form W-9, and on that W-9 they will indicate whether they are a corporation or they are not a corporation. And they will give you their address, their identifying data, things like that, so that by January 31st of 2017, you can issue them a 1099 for 2016. And the reason I'm emphasizing this so much is the IRS has doubled the penalties. If they catch you not issuing 1099s, the penalty is now $500 per failure, not per year, but per failure. So if you had 5 1099s that you did not issue and they caught you, right, you could be subject basically to a $2,500 penalty. So again, everyone, these are things that you need to talk to your accountant about. But for your accountant not to agree with me on most of these ideas would be a real surprise. Now, the last thing I want to talk about is something I talk about in all my seminars, and that is the issue of, is it entertainment, which is only subject to a 50% deduction point? All right, let me say that again. Is what you're spending an entertainment item, which is limited to a 50% of what you spent deduction, or is it really business promotion, which is 100% deduction? And my point is this. You need to really think about when you're spending money, why you're spending money. For example, our firm just had a client appreciation event where after 10 years of being in business, basically the owners hosted a very, very nice function back in October where we hired several bands, we took over the town center, and we basically allowed every realtor to bring so many of their clients. And we had over 800 people there for the entire evening. Well, the owners paid for this, and may I guarantee you this, this was not entertainment of our clients, this was promotion of our business, this was promotion of our brand. And I guarantee you that we will all be deducting 100% of this. So my point is this. If you are simply entertaining a client or a client and their spouse, both clients, I'd probably call that entertainment and take 50% of it. However, if you are basically promoting your business by a group of people, by seeing a group of people or spending money on a group of people, a group larger than 2, then I would highly recommend you categorize that as business promotion or business advertising. And then again, talk to your accountant about some of the things that I've said. So everybody, I want to thank you for your time. I'm going to now look at my phone and check the questions that I've got and try to answer as many of them as I can. So the first question I've got, is the home office safe harbor a deduction on personal taxes or on the business return? It is literally a business deduction. So if you file as a Schedule C, there's a specific line that goes on the Schedule C. If it's an S corporation, it's going to be done a little bit differently. I'll tell you why. Your instructor is an S corporation, so the normal home office deduction does not work the way I explained it. In my case, the way you do it with an S corporation, my S corporation pays me rent. In fact, my S corporation pays me $1,000 in rent a month for a total of $12,000 a year. So the S corporation pays that and deducts it as rent. I then basically pick up the $12,000 as income, and then I take my allocable share of some of the utilities, insurance, things like that on my Schedule E of my tax return. So that's the way it's done for an S corporation. And what it really means for the S corporation, it's another way of getting, for example, my $12,000 out of the S corporation without paying Social Security tax. I have another question. Was it stated that if you have a home office, then you can deduct every single trip out of your driveway, or was that only if you are using a special type of home office deduction? All right, what I'm saying is basically if you have a home office, a qualified home office that you are deducting, instead of, what I'm trying to say is with that situation, you are never commuting, all right? So if you leave your home office to go to your other office, for example, your broker's office, that is not commuting expense, that is deductible business mileage. Likewise, you leave your home office to go show 4 houses, that is deductible business mileage. And I'll tell you right now, that is the number one hidden reason the IRS does not like the home office deduction. But this does bring up another point I need to explain. One thing that I did not say earlier is you have to be able to prove, if you've got a qualified home office, that you are spending the greater majority of your time doing the administrative and management tasks of running the business out of your home office and nowhere else. So for those of you that would have a team at the broker's office and you would be spending the majority of your time doing the management and administrative tasks of running your business where your team is, I would tell you to give up on the home office. But if you are doing the majority, and I'm going to say 70 to 80% of your time doing the business and the management and administrative tasks of running your business from your home office, and you use it exclusively and regularly, that meets the test for the home office deduction. Those people that have been audited by the IRS and who have won on the time test, 70 to 80%, are the ones who have kept a log, like a spiral binder, right, of what you do on a daily basis. Take a couple of minutes and jot down a paragraph of what you have done that day. Another question. What about closing gifts? Can we deduct 100% if it is logoed for the business or just $25 per gift? And this is a wonderful question, everybody, and it's something that I really take the time to talk about in one of my 3 or 4 hour seminars on the road. But just think of something like Cutco Cutlery for just a minute. CUTCO. There's your name on that cutlery. Every time they pick that knife or that bread cutter up, whatever it is, there you are. And Cutco, basically, the many times I've talked to them, says that they have defended their position in court, that it is not a gift, that it is advertising or promotion of the business. So I'll keep my discussion on just Cutco for that regard. And that's clearly a case where that would not be a gift, in my opinion. It would be business promotion or advertising. I have another question. How many under 600s can I deduct for contract labor from family and friends, passing out business cards, helping me with signs, etc.? Well, please don't misunderstand this. Number one, I'm not telling you get all these deductions for nothing, but if you genuinely, there's no $600 deduction. You might have misread me wrong. My point was that if you pay somebody $600 or more, you must give them a 1099 for all the reasons I said earlier, that they're not a corporation, they didn't work for you in your trade or business, things like that. But I do not mean this as a way just to spend money to get a write-off. Only you can decide where to spend your money. Only I can decide where I spend money in my business. But let me just say this. If you hired your children, all right, to basically put out flags for you over the 4th of July, and you paid a child $700, all right, and you treated them as an independent contractor, I would suggest you need to give them a 1099. Now, that raises another issue, though. on hiring your children, you may not want to pay them as an independent contractor. You may want to pay them as a W-2 employee, because if they're under 18 and you are not a corporation, the payor, the children are free of basically Social Security tax coverage. But if you are an S corporation and you pay your kid regardless of age, you do have to pay Social Security tax. You know, one question leads to another, and all of a sudden a 45-minute webinar can be a 4-hour course, which it cannot be. But above all, I'm trying to give you things to talk to your accountant about. Now, another question. This has come up twice. Can an S corporation provide medical benefits to its employees? Well, again, this is a loaded question. So let me say this. For employees that do not own the corporation, the answer is yes, it can. But when you have a shareholder who owns more than 2% of the stock of the corporation, which is me, which is primarily all of you, and I'm sure is the person asking this question, can an S corporation provide medical benefits to employees? It is a real problem for the owner of the S corporation. And I'll give an example. My S corporation pays my health insurance, but because I own more than 2% of the stock, I cannot deduct that. My S corporation cannot deduct that as insurance premiums. Instead, the S corporation adds it to my wages and deducts it as part of my salary, but then I have to pay tax on that on my individual income tax return. So there's much more to this question the person is asking me, but there's an attempt at giving you a brief answer. And then I have a question. Do you process individual returns or just do seminars, etc.? Well, no, I do both. I have a limited tax practice of about 150 taxpayers. However, they're all in the local area. I do no out-of-state returns whatsoever. So if this person is asking me if I would do their work or not, I really thank you for the honor of asking me, but I'm not interested in expanding that part of my practice unless you just happen to live anywhere near Champaign-Urbana, Illinois. But out of state from Illinois, I'm really just not interested. Can I repeat the announcements from the beginning of the seminar? Yeah, we did have some technical difficulties in the front end. So let me give you some of the announcements. First of all, if you enjoyed this course, you can find my tax course. I have one tax course on KeynoteCommunity.com. I also advise to subscribe to Keynote mailing list, because if you sign up for a course today, there's $5 off the first course. Also, I announced that the next Facebook Live presentation would be on 1/16 of 2017. Chandra Hall, a good friend of mine, excellent speaker, she really knows what she's doing, is doing a session on systems that keep you sane. And that'll be 1 o'clock on January 16th of 2017. The other things I kind of mentioned at the first, everybody, that you may have not heard, and let me just say it again, is with the recent election results, and this is not a political statement, but there's a lot of discussion going on right now as to what tax strategies should we start thinking about with potential tax changes coming next year. And probably the three biggest recommendations are, if you still have the opportunity to defer income, that is to put off taking a closing or something like that in 16, put it off until 17. There's a good likelihood that we're going to have lower marginal tax rates next year, whatever the words good likelihood means, all right? Likewise, if you have learned anything in the last 45 minutes about deductions, and I have opened your eyes to a deduction, for example, the SUV or the pickup truck, and you've had a really, really good year this year, you may want to think about taking delivery of one of those vehicles this year for purposes of getting your deductions in a year of higher marginal tax rates than next year lower marginal tax rates. And a third offering I made, or the third recommendation, was If you have a sale of an asset like mutual fund, stocks, or possibly a real estate property, in 16 that you could put off until January of 17, you may be able to take the net investment income tax of 3.8% out of the question, because the rate really applies in 16, but Don Trump says he wants to get rid of it with his new tax legislation. But again, I also said that it's rolling the dice, because we don't know at this point in time what he's going to be able to get through in tax law and what he's not going to be able to get through, and only time will tell on that. Now, let me take another question. All right? We handle several homes in property management and have replaced a privacy fence for about 3,700. Man, I'm loving this question, and this is going to be the last question I take, but I'm going to spend a few minutes on this. Let me say it again. We handle several homes in property management and have replaced a privacy fence for about $3,700. It broke down to about $2,400 in materials and the balance in labor. Is there a way to deduct this expense in the calendar year? Yes, yes, yes. Now here's what you got to do. You need to get to the fence vendor, the privacy fence vendor, and have them reissue 2 invoices, one for the fence material and one for the labor. Now I'm assuming that if the materials came in at $2,400, the labor is going to come in at $1,300, because you now have 2 invoices, each of which is $2,500 or less. You will be able to expense this privacy fence under the de minimis safe harbor deduction. Now, in closing, everybody, first of all, I want to thank you for your time, and I want to wish you all the merriest Christmas and the happy holidays, and I want you to have a wonderful year end like I'm anticipating doing myself. But more than anything, I am just the messenger, all right? You've got to take what I've talked about, and you've got to sit down with your accountant, even if you have to do it in the next 2 weeks, and say, okay, here's what I got, all right? And what do you think of this? And I can't believe they're going to materially differ with me on anything, all right? The only real judgment call is the salary versus distributions from an S corporation. Other than that, this stuff is very, very clear, and I believe that most of your accountants will feel exactly the way I do. And again, everyone, I want to thank you for the time you've taken to spend with me. I hope you find this time worthwhile, and I sure hope to see you on the seminar circuit or at CRS meetings or conventions next year. God bless.